All right, welcome to Talk Tickers. So Mondelez just dropped their Q4 earnings, and on the surface, it looked like a pretty solid win. But then, the stock took an immediate nosedive. So today, we're going to roll up our sleeves and dive into that fine print to figure out what in the world just happened.
I mean, this is the big question, right? It's the central paradox of this whole report, and it's exactly what we're here to unpack. How on earth does a company beat expectations and still get punished by the market? It just doesn't seem to add up.
So take a look at this. On one side, you've got the beat. Adjusted earnings per share coming in almost 3% ahead of what everyone was expecting. That's a clear win, no doubt about it. But then you look at the other side, the market's reaction. The stock dropped over 4% after hours. So what did investors see that made them hit the sell button so fast?
Okay, to really get to the bottom of this, we first have to look at the headline numbers. The ones that, on paper, should have sent this stock soaring.
So yeah, Mondelez reported $10.5 billion in revenue, which beat the $10.3 billion consensus. And on the bottom line, same story. Adjusted earnings of 72 cents per share, topping the 70-cent estimate. So a beat on both top and bottom lines. But, and this is a huge but, the real story here isn't what they sold. It's all about how they sold it.
And this, right here, gets us to the absolute heart of the market's concern. See, that revenue beat, it wasn't driven by selling more Oreos and Cadbury bars. Nope. It came almost entirely from just jacking up the prices on the ones they did sell.
And you know what? That strategy of just raising prices is clearly starting to show some serious cracks. This wasn't a story about soaring demand at all. In fact, if you listened to the earnings call, management said over and over that consumers are starting to push back. And that brings us to the real problem, volume.
Yeah, on the call, they flat out admitted that consumer elasticity, which is just a fancy word for how sensitive people are to price hikes, was way higher than they thought it would be, especially over in Northern Europe. At the same time, the U.S. biscuit business is looking pretty weak, and they're seeing a really clear trend of shoppers trading down to cheaper value brands. It just goes to show you can only pull that pricing lever so many times before it breaks.
All right, let's switch gears to the other major headwind here. And honestly, this might be the most fascinating part of the whole call, the absolutely wild volatility in the cocoa market. Man, this created a real strategic nightmare for the company.
This right here perfectly explains the trap they walked right into. So cocoa costs were skyrocketing through 2025. Mondelez, being smart, did the prudent thing. They hedged. They locked in their prices for 2026 to get some predictability. Makes sense, right? But then, plot twist, just weeks before this earnings call, the spot market for cocoa suddenly crashed. So now they're stuck holding the bag with these higher cost ingredients, while their competitors who didn't hedge as much could swoop in and cut prices. That puts Mondelez in a really, really tough spot.
And look, the CEO, Dirk Van de Put, he didn't beat around the bush. He said it directly. This crazy timing mismatch introduces a massive amount of uncertainty. They just don't know how their competitors are going to react. So what do? They had to build a ton of caution into their outlook for the year. And that caution, that's exactly what torpedoed the stock. Which brings us to the big one, the real reason for the sell-off. You got to remember, the market is a forward-looking machine. It cares about tomorrow, not yesterday. And when it looked at Mondelez's forecast for 2026, well, let's just say it did not like what it saw. Here's the kicker. Their guidance for adjusted EPS. Management put out a range of $2.92 to $3.07 a share. The problem? Wall Street was looking for $3.13. Oof. That's not just a miss, that's a significant miss, and it signals a major slowdown from their previous growth. So, at the end of the day, that's what happened. The market heard that super cautious tone from management, completely looked past the Q4 beat, and immediately started pricing in all that risk for 2026. The entire story just shifted. They went from being this global snacking giant that just keeps growing to a company that's basically just bracing for a year of uncertainty and, well, stabilization, not growth. So the big question is, where does the stock go from here? Well, this brings us to the next call, our segment where we lay it all out. We assign a rating and pitch a trade idea based on everything we just heard. Okay, so here's our take. We're initiating coverage with a market perform rating. Look, this company has some undeniable long-term strengths for sure. But these short-term headwinds, the whole cocoa mess and the very real volume pressures, they create a pretty balanced risk-reward profile. We just don't see a strong reason for this stock to outperform the market until we get a lot more clarity on those two big issues. So what's the trade idea? We're thinking a classic pair trade. Here's how it works. You go long the broader consumer staples sector. You can do that using the XLP ETF, and at the same time, you go short Mondelez. Now, the logic here is pretty simple. While the entire sector is dealing with pressure on the consumer, Mondelez has this extra, company-specific layer of risk from that whole cocoa hedging situation. So this trade is really a bet that Mondelez is going to underperform its peers, at least until it can navigate its way out of this storm.
This is not financial advice.